pricing BOVs for every servicer, for Fannie, Freddie, you name it. Who buys this stuff at the end of the day? And how do you finance it also?
You know, I think for some of those distressed properties that are over-leveraged, you're seeing more middle market buyers who will take the time to understand the issues with the property and turn it around. It's a situation where you have to get your hands dirty and really understand, you know, how to turn around a negative situation. To finance them, you know, you can finance notes right now. You can finance distressed properties. It's not easy. I think it's you know, most of those buyers will be all cash buyers. There is financing probably at the 50, 60, maybe 65% leverage level. It's more expensive money in the 8 to 12% range, and you have a number of funds trying to make those loans right now. But ultimately, most of the distressed properties that we see go through the system and get acquired are all cash buyers and middle market players that have some money behind them and are looking to grow their portfolio and turn some properties around to make them profitable.
Mason?
Yeah, you know, look, we're always looking for distressed opportunities. I mean, that's where you're going to get the opportunistic returns in an environment that we're in where, you know, if you're in a zero interest rate environment, I think people are adjusting their return expectations in this sector. So it's, you know, mid to low to mid teens. So for us to actually achieve our return requirements, we're going to have to buy something with some hair on it. We tip, in a situation like this, one of the things that we like being in a position to do is buy all cash. And you know, be able to close quickly, which we think gives us a competitive advantage. Dealing with the special servicers so far, it hasn't been that easy, both as a borrower and as a potential buyer. So we'll see how that all plays out in the future. Hopefully, they will open the spigot a little bit more.
Okay. Questions, sir?
I can talk a little bit about the inflation. You know, I think you'll see interest rates stay relatively low until economic conditions improve a little bit. And I think, but ultimately, we all know, you know, how much money the government has printed, and that's inevitably going to create inflation and higher interest rates. So I think when you're looking at your you know, your exit strategy, you know, when rates do go up, you have to assume when inflation goes up, that cap rates may tick up a little bit too. So, you know, it's a situation where, you know, by the end of 2010 or early 2011, you know, interest rates should start to tick up, and that'll obviously affect IRRs and exit cap rates. I think some of the other gentlemen could probably give us a better idea of where they're underwriting to exit cap rates right now.
Just a quick comment on inflation. I believe the Fed is actively pursuing a weak dollar asset reflation strategy by keeping the interest rate at 0%, by literally printing billions of dollars of cash into the economy. So that just fit into the scenario, there will be future inflation. The question is when. Our expectation is that they will start raising the overnight fund rate second half next year. So when that happens, that will trigger quite a bit of asset allocation shift from Treasury to inflation hedge security instrument like commercial real estate. So it's going to impact the sector, and you have to take that into consideration.
As it relates to reversion cap rates and our underwriting, again, it is market specific. You know, we're national buyers, so we're going to use different reversion cap rates for different product type, different markets. I think on average, you know, we're probably 25 to 50 basis points higher than what we're going in at. It's moved down a little bit in the last couple months as the market's been a little bit more competitive. On average, probably somewhere between 7.5 is our reversion today. And I guess as it relates to inflation, I think we all believe there will be here at some point, and it will affect interest rates, and hopefully it will bring our rents up at the same time. But we also think that today, because of the attractive financing, that if we are able to acquire an asset and put long-term cheap debt on, when we do go to sell the asset in 5 to 7 years, that will be beneficial to us on the sales process because we will be selling with below-market debt, and that should help us when we sell it.
That's really the biggest question, is where are cap rates and where are lending rates in the future. Just there always should be a premium to your cap rate from the borrowing rates. So I don't know where borrowing rates are going to be 5, 7, 10 years down the road. I am deathly afraid that they're going to be 9, 10%, and you could probably come up with a scenario that they are such. So when we look at it, even though we're IRR-driven buyers, on the multifamily side, we're really also just focused on trying to get our investment back over the hold period. So we might look at it, and today you could probably buy, today you can buy attractive assets at a 7 cap and finance them at 5.5%. Okay, and if you hold that for 8, 9 years, you get all your money back. So that's generally what we're looking at. And putting the cap rate on the exit is anybody's best guess. But if you can look your investors in the eye and say, look, at least I returned capital, and I gave it my best shot. If cap rates are 13% in 2017, we're in a lot of trouble. So.
Mason, everyone here is saying, and I think everyone in the audience is why we're here, you're buying apartments because cheap debt, available and inexpensive debt, not necessarily cheap, compared to the other asset classes. Is there any risk in you guys' minds that that debt either goes away or gets consolidated? Because right now, Fannie, Freddie, and then HUD has the entire market, right? What's your risk on? What's your thoughts on that?
Well, first of all, there are two reasons. It's the cheap debt combined with the relative stability, even though it's declining, the relative stability of the rent roll. Again, for people like us who invest in 3 or 4 different sectors, office, industrial, retail, the quality of the rent roll is I would say actually the primary driver, and the quality of the financing is a secondary driver. But still, very, very important. Will this stay there? For us, we spend a lot of time talking about this. It's very hard to predict, but for us, the public policy purpose of supporting owners of multifamily housing, it's sort of hard to define that. So why there's all of this financing, cheap debt in the market right now? What is the public policy for that? It's not supporting the renters per se. It's a step removed from that. But I think the agencies have gotten themselves in a bit of a pickle. I think it's going to be very hard to withdraw because they're long. They're long a ton of this stuff, and if they withdraw it, they've got their own problem on their own balance sheet. So I think they've created a problem that almost forces them to keep it going. And if they're going to get out, they're going to have to do it very, very slowly.
Just to add a point on Mason's statement, not only we like a cheap debt for apartment, but also if you play the recovery of U.S. commercial real estate, apartment along with the hotel probably are the first 2 sectors to recover. So that got to be part of your strategy to buy apartment, because apartment historically has highly correlated with job creation. So as soon as we start job growth, apartment will hit the bottom, and apartment, I believe, will be the first one to have rent growth. Compared to industrial office and retail.
I think Mason kind of hit it on the head. I mean, Fannie and Freddie, it only hurt themselves, really, their balance sheet, if they don't continue to fund stabilized multifamily properties. But I also think you have to look at the underlying asset here, which Kevin and Mason said. They're stable assets relative to most other assets and most other commercial real estate assets. And especially in New York City more than anywhere else, you have bank money chasing multifamily too. The local banks here are very competitive, a little bit different than Fannie and Freddie, but certainly competitive. And I think because of the stable nature of multifamily and how Tim said, it will come back and rent rolls will increase. There'll be more money chasing it. I think life companies, they'll have an interest in multifamily as well. And if Fannie and Freddie become a little less aggressive, maybe the life companies can step in and compete.